Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within company filings. And today we are looking at Commercial Metals Company. And let me tell you, they've been busy raising some serious cash. So Commercial Metals Company, or CMC as they are often called, an established player in the metals industry, has just dropped a report detailing a significant financial move. They've announced the pricing of a massive debt offering, and it is not just a small note, it is a $2 billion deal. To be precise, they are issuing two tranches of senior notes, one set maturing in 2033, with a 5.75% interest rate, and another maturing in 2035, carrying a slightly higher 6.00% interest rate. This is a big move to secure funding, and it is being done through what is called a private placement. Now, what does private placement mean, and why is it important this means? They are not selling these notes to just anyone, they are selling them to sophisticated investors, like large investment funds and institutions that are expected to know the risks involved. They are using a regulation called Rule 144A, which allows for the sale of these securities to these qualified buyers without the full registration process required for public offerings. This makes the process faster and less burdensome for the company. On top of that, some notes are being offered to non-US persons outside the United States, following another regulation called Regulation S. So why all this debt raising? Well, the primary reason is an acquisition. CMC is planning to buy Foley Products Company LLC. This acquisition is a major strategic move, and raising $2 billion highlights the scale of this transaction. They are also earmarking some of these funds for transaction-related fees and expenses and for general corporate purposes. Here is an interesting detail: the note offering will happen before the Foley acquisition is finalized. This means CMC is securing its funding first and then going through with the purchase. It also means that if for some reason the Foley acquisition doesn't go through, or if the agreement for it is terminated before a certain date, even though the notes have been issued, CMC will have to buy them back. This is essentially a safety net for the note buyers. If the acquisition falls apart by the 15th of October 2026, the investors get their money back plus any interest that is accumulated. This is known as a special mandatory redemption, and it is quite an important condition in this deal. It shows the company is confident in the acquisition, but also prepared for contingencies. The company also put out a press release on the 12th of November to announce the pricing of these notes. This press release is attached to this filing as Exhibit 99.1, and it provides more detail on how this whole debt offering went down. It also serves as a way for the company to inform the public about this significant financial event. Now let's quickly look at what is currently registered with the exchange. Their common stock is traded on the New York Stock Exchange under the ticker symbol CMC. This is the stock most investors would be familiar with. Now let's talk about the big picture here. Commercial Metals Company is taking on a significant amount of debt to fuel growth through an acquisition. This is a common strategy for companies looking to expand their market share or enter new markets. The acquisition of Foley Products Company LLC suggests CMC is looking to diversify or strengthen its product offerings within the broader metals and manufacturing industry. The company is incorporated in Delaware, a common state for large corporations due to its business-friendly laws. The key takeaway from this filing is the company's aggressive expansion strategy funded by debt. The success of this strategy hinges on the successful integration and performance of the acquired company Foley Products Company. If the acquisition pays off, the debt will be a worthwhile investment. If not, it could put a strain on CMC, its financial health. The special mandatory redemption clause offers some protection to investors, which is a positive sign of transparency. Looking ahead, investors will be closely watching the performance of Foley Products Company post-acquisition and how CMC manages its increased debt burden. The interest rates on these notes are not insignificant and will represent a recurring cost to the company. We will definitely be keeping an eye on CMC to decode what comes next. Alright, that is our breakdown of Commercial Metals Company's latest move. What is your take on this acquisition and debt strategy, and what do you think it signals for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more corporate deep dives. Don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching, see you next time.